Imagine waking up one morning to find that interest rates on your savings accounts have been frozen. It sounds like a plot from a financial thriller, but it's a very real possibility that affects every single one of your savings accounts, regardless of how much money you have stashed away. In the United States alone, there's approximately $40 trillion in bank deposits, with over 140 million households storing their hard-earned cash in banks and credit unions. That's roughly $286,000 per household, according to data from the Federal Reserve. Think about it, this amount is equivalent to the entire GDP of countries like Sweden or Switzerland. Now, let's talk numbers. Suppose interest rates on your savings account were frozen at 2% today, as they are currently. If you had a $10,000 balance in that account, your annual earnings would be $200. But what if I told you that this rate is subject to change without warning? In fact, interest rates can fluctuate rapidly, and it's not uncommon for them to plummet or spike by 1 to 2% within a matter of weeks. What happens when rates freeze overnight? Theoretically, it means your earnings on that $10,000 balance would come to a grinding halt. No more annual earnings of $200, no more incremental growth on your savings. But the impact goes far beyond just individual accounts. A frozen rate would have a ripple effect throughout the entire economy. Consider this, if interest rates were to freeze tomorrow, it's estimated that over $100 billion in question marks would be placed against savings accounts across the country. That's right, $100 billion in earnings potential, lost overnight. And for many households, this could have serious consequences on their financial planning and stability. As we discussed earlier, the United States boasts an impressive $40 trillion in bank deposits, a staggering figure that underscores the sheer magnitude of individual savings. This sum is comprised of not only high-net-worth individuals but also everyday citizens who rely on their savings for essential expenses and long-term financial goals. Now, let's dive deeper into what happens when interest rates freeze overnight. The Federal Reserve, responsible for setting monetary policy in the United States, has a significant impact on borrowing costs and subsequently, savings rates. When interest rates drop or rise, it can have far-reaching consequences for savers, with $100 billion of their hard-earned money potentially at stake. A sudden freezing of interest rates would leave millions of Americans questioning their financial decisions. Consider this, the average American has approximately $60,000 in savings, a figure that may seem substantial but is often insufficient to weather economic downturns or unexpected expenses. When interest rates remain stagnant, these savers are essentially earning nothing on their deposits. The implications are profound. A sudden loss of purchasing power due to inflation or stagnant wages would further erode the value of savings. For instance, if inflation were to rise by 2% annually, a $60,000 nest egg could be worth significantly less in just 5 years, assuming no interest earnings. Moreover, this frozen landscape raises fundamental questions about the role of banks and financial institutions. If interest rates remain static, would they continue to offer competitive deposit rates? Would they instead focus on other revenue streams, potentially at the expense of their customers? In a rapidly shifting economic environment, it's essential to understand how these events can affect individual savings accounts. What happens when $100 billion in deposits is stuck in neutral, unable to earn meaningful interest or keep pace with inflation? The answers lie ahead, and they may challenge everything you thought you knew about saving for the future. When interest rates were raised by the Federal Reserve last year, it was a carefully calculated move to combat inflation. The decision to increase rates had an immediate impact on savings accounts across the country. As soon as those rate hikes took effect, millions of Americans saw their savings earn more interest than they had in years. But now, as we're seeing economic indicators shift once again, there's growing speculation that the Federal Reserve may be poised to make a sudden and significant change, freezing interest rates altogether. This prospect is sending shockwaves through financial markets, with many economists warning of potential consequences for millions of depositors nationwide. In 2022, Bankrate reported that an astonishing $100 billion in new deposits flowed into savings accounts as Americans scrambled to take advantage of higher interest rates. These deposits represented a significant influx of capital into the banking system, and it's precisely this liquidity that could be impacted by a sudden rate freeze. One key development to note is the recent trend of banks offering more competitive deposit rates, particularly on certificates of deposit, CDs. With these rates rising as high as 4.5% in some cases, many savers are now reaping rewards they hadn't seen in years. However, if rates were to freeze at their current levels or even decline, it could lead to a ripple effect throughout the financial system. Some analysts point out that the Fed's rate decisions have become increasingly data-driven, with policymakers closely monitoring economic indicators like inflation and employment numbers. If the central bank determines that further action is needed to stabilize the economy, a rate freeze may be the next logical step. But what would this mean for your savings account? As interest rates freeze overnight, a staggering $100 billion in question marks would hover over every single one of your savings accounts. To put that number into perspective, consider the fact that just last year, Americans earned an estimated $150 billion in interest income from their deposits alone. This isn't just about individuals, institutions and businesses also rely heavily on these interest earnings to fund their operations. For example, pension funds have historically counted on steady returns from low-risk investments like certificates of deposit, or CDs. These instruments offer a guaranteed return for a fixed period in exchange for tying up a certain amount of money. However, if rates freeze, the potential earnings from these investments would be severely diminished. In fact, according to estimates by Fitch Ratings, every 1% change in interest rates affects pension fund returns by around $15 billion. As the ripple effect spreads throughout the economy, consumer spending and confidence are likely to suffer as well. People will have less disposable income available for non-essential purchases, which can lead to a reduction in economic growth and potentially even recession. This isn't just theory. During periods of rate freezes or cuts, we've seen GDP shrink by up to 10% within the first 6 months. Banks themselves stand to lose around $20 billion annually due to reduced interest income from deposits alone. They would be forced to find alternative sources of revenue, which could lead to higher fees and more restrictive lending practices for consumers. It's a classic catch-22 scenario: rates freeze, banks suffer, banks raise fees, consumers are hurt further. The prospect of interest rates freezing overnight is a daunting one, with far-reaching consequences that extend beyond the realm of finance. If such an event were to occur, it would not only affect individual savings accounts but also have a ripple effect on the entire economy. The numbers are staggering. $40 trillion in bank deposits is a massive pool of money, and if interest rates were to freeze, it's estimated that around 10% to 15% of this amount could be at risk. This may seem like a small fraction, but when you translate it into actual dollars, the figure becomes almost unimaginable. We're talking about $4 trillion to $6 trillion in potential losses. And these numbers are not just theoretical, they're based on real-world scenarios and expert analysis. The idea that interest rates could freeze overnight may seem far-fetched, but it's a possibility that financial experts take seriously. The consequences of such an event would be felt across the board, from individual savers to large corporations. Banks and other financial institutions would need to absorb these losses, which could lead to a reduction in lending and investment. This, in turn, could slow down economic growth, leading to widespread job losses and decreased consumer spending. The Federal Reserve has been warning about this possibility for some time now, but the response from lawmakers has been muted. The fact that there's no clear plan in place to mitigate these risks raises more questions than answers. What would happen if interest rates were to freeze overnight? Would savers be able to withdraw their money? Or would they be stuck with a frozen account balance? Now that you've learned what happens when interest rates freeze, let's put the stakes into perspective. If rates were to remain frozen